Okay, let's dive into this. Picture a company, right? And they're managing something like $10.6 trillion.
Trillion. With a T.
Yeah, it's wild. That's what, more than half the entire GDP of the US?
Easily. It's an astonishing figure.
And the name on the door, BlackRock. Now, I know for those of you who listen to our McKinsey chat, BlackRock probably popped up on your radar.
Yeah, we got a few messages, people asking for a closer look.
Exactly. You asked, so here we are. We're doing the deep dive.
And it makes sense. There's so much talk around them.
Oh, absolutely.
Huh.
Online, it's a frenzy sometimes. You hear these theories.
Like what?
You know, like a giant robot pulling the strings, controlling more cash than whole countries. Larry Fink as the, quote, commander-in-chief.
Right. The idea that they're secretly running things.
Yeah, or that they own bits of like 95% of Fortune 500 companies, deep ties with governments. It feels a bit like a thriller sometimes.
Well, that's the big question, isn't it?
Yeah.
How much of that is real and how much is just noise?
Mm-hmm.
Are they actively, controlling the world? Or is it more passive, more complicated?
That is exactly what we need to figure out. Are they pulling the levers or are they just sort of reflecting the market because they're so massive?
And what about the other big players?
Mhm.
State Street, Vanguard, the big three as they're called.
Right. What's the real story there? How do they all fit together?
Understanding what they actually do is probably the first step, the mechanics of it all.
Okay, so today's mission, if you will, we're going to unpack what an asset manager actually is. We'll look at index funds, super important.
Commercial, yeah.
This idea of passive investing, what that even means, something called universal ownership.
Sounds ominous.
Kind of does, right? And just, where BlackRock actually sits in this whole economic picture.
Sound good. So first things first, BlackRock is an asset manager.
Okay, break that down. What does that mean in simple terms?
Basically, they take money from clients, big clients usually,
Yeah.
and their job is to try and make that money grow.
So managing assets
Mhm.
makes sense.
Yeah. Exactly, professional money managers, but on a huge scale.
And a lot of their power, the foundation of it, seems to come from index funds, right? Something pioneered back in the 70s.
That's right. Jack Bogle at Vanguard, really. He championed the first index fund for individual investors. It was revolutionary.
How do they actually work? Index funds.
Well, instead of trying to pick winning stocks, like I think Apple will go up, an index fund just buys, well, pretty much everything in a specific market index.
Like the S&P 500.
Exactly. So the fund mirrors the performance of that whole basket of stocks.
Ah, okay. So it's like betting on all the horses in the race instead of just one.
That's a great analogy, yeah. You're not trying to beat the market, you're trying to be the market. Lower risk, generally more consistent returns over time.
And cheaper, too, I bet. Less research needed.
Much cheaper. You don't need legions of analysts trying to find the next big thing. So for BlackRock, these index funds, and also ETFs, exchange-traded funds, which are similar, that's their bread and butter.
Gotcha. So that leads to this passive idea. They buy a bit of everything in the index and just hold it.
Pretty much. Buy and hold. They're not constantly trading, buying, and selling based on hunches. That's active management. This is passive.
And being passive, that label, it gives them some kind of advantage. You mentioned legal leeway.
Well, yeah, the regulations can be different for passive investors compared to active ones who might be seen as trying to exert more direct control.
Okay, but here's a twist, right? They are so huge, they almost have to be passive to some extent.
How do you mean?
Like if they own, say, 7% of a company and they suddenly decide to sell all of it.
Oh, right. That could crash the stock price. A huge seller hitting the market like that.
Exactly. So their size kind of forces their hand. They're almost locked in a way. Selling big chunks is just too disruptive.
That's a really important dynamic. Their scale dictates a certain strategy. Now, about that $10.6 trillion, whose money is it actually? It's not BlackRock's personal piggy bank, is it?
No, absolutely not. And this is key. Most of it comes from what are called institutional investors.
So like big organizations.
Yeah, massive ones. Think pension funds, managing retirement money for teachers, firefighters, government workers,
Okay.
insurance companies, big nonprofits, university endowments, huge pools of capital.
Right, the really big fish in the financial ocean.
But then, if you trace it back, where does that money come from?
Ultimately, from people.
Exactly. It's your pension contributions, maybe your 401k if you have one, the money set aside for college tuition, the premiums you pay on insurance.
So when BlackRock is managing this wealth, it's actually indirectly our money.
It's your money. That's the thing to really grasp. But, and this is a big but, you, the individual whose money it ultimately is, you generally have zero say in how BlackRock invests it.
The decisions are made much higher up the chain.
And you'd think their main goal is just getting the highest possible returns, right?
You would, and good returns certainly help keep clients happy, but that's not actually their primary source of profit.
Oh, so what is?
It's the fees. They charge their clients a fee, usually a small percentage of the total assets they manage.
Ah, so the more money they manage, the more they make in fees, regardless of whether the market is soaring or just okay.
Precisely. Professor Benjamin Braun pointed this out. Growing assets under management, or AUM, that's the name of the game, get new clients, get current clients to give you more money.
So if you manage $10 trillion, even a tiny fee, like 0.1%, is,
Billions in revenue. Yeah.
wow. Okay. So they need to invest all this money, trillions of dollars. Where does it all go?
Well, if you're managing that much, and a lot of it is going into index funds, you end up owning a piece of almost everything.
Which brings us to universal ownership. Sounds grand.
It describes this situation where a few massive asset managers, mostly the big three, BlackRock, Vanguard, State Street, hold shares in practically every publicly listed company.
So they're everywhere.
Pretty much. Now, BlackRock's stake in any one company might only be, say, 3 to 10%.
Yeah.
Relatively small on its own.
But wait, 10% isn't small. And even 5%, isn't that often enough to be the biggest single shareholder?
Absolutely. Because ownership in big companies is often really spread out. So yeah, having 5% or 7% often makes you the #1 shareholder, or at least in the top few. That 5% mark is often seen as a threshold for potential influence.
And remember, it's not just BlackRock doing this. Vanguard and State Street have very similar models.
Right. So you add their stakes together. Take Amazon, for example.
Okay.
The big three together own about 16% of Amazon's shares. Jeff Bezos owns around 9%.
Whoa. So collectively, these passive managers own way more than the founder.
In that case, yes. That shows the concentration.
And owning shares means owning votes, right?
Yeah.
At shareholder meetings.
Exactly. The more stock you hold, the more voting power you have.
And-
And because they own so much across the board, BlackRock is almost always one of the top 3 to 5 shareholders, meaning they have significant voting clout.
And again, remind us, whose votes are these really?
Technically, they belong to the owner of the shares, which is the fund BlackRock manages. But ultimately, it represents the capital from those pensions, those insurers.
So it's like our money, but the voting rights got signed away somewhere up the chain. It feels a bit like pyramid scheme vibes, as one source put it.
It's a disconnect, for sure. The ultimate beneficiaries are far removed from the voting. And how do they usually vote?
Good question. Do they shake things up?
Well, a big study back in 2017 found they almost always vote with company management's recommendations, overwhelmingly.
Really? Why would they just rubber stamp what management wants?
That's a complex question. Part of it goes back to how executive pay changed.
How so?
Decades ago, managers maybe had more freedom. Sometimes investors felt executives were, spending too much on perks instead of profits.
Okay.
So the big shift was tying executive pay much more closely to the company's stock price, mainly through stock options.
So if the stock price goes up, the CEO gets richer.
Exactly. It created a huge incentive for managers to focus laser-like on things that boost the share price, which generally means boosting profits, especially short-term profits.
Which aligns them with shareholders, or at least the idea of shareholders.
Right. But it arguably shifted focus away from maybe longer-term goals or employees or the community.
And this is different from how it used to be.
Very different. Go back to, say, the mid-20th century. Back then, most stock wasn't owned by big institutions. It was owned directly by households, by individuals.
Really? Like regular people owned way more stock?
Way more. In 1945, households owned something like 94% of all U.S. stocks.
94%. Wow. And today?
Today, it's around 40%. And even that 40% is heavily concentrated.
How concentrated?
The top 1% of Americans own about half of that 40%. The top 10% own something like 86% of it.
And the bottom 50% of Americans?
Own a tiny fraction. Really smart.
So this whole argument that what's good for shareholders is good for everyone, it kind of falls apart when you see who the shareholders actually are, doesn't it?
It definitely complicates that narrative.
Yeah.
The benefits of maximizing shareholder value flow very disproportionately to the wealthiest segment of the population.
And this concentration, this universal ownership by the big three, does it have real-world effects, like on us?
Well, some economists argue yes. Take wages, for instance.
Okay.
If the biggest shareholders are consistently voting for strategies that maximize short-term profit, one of the easiest levers for companies to pull is controlling labor costs, keeping wages down, reducing benefits, that sort of thing.
So it could contribute to wage stagnation?
That's the argument. Squeezing workers boosts the bottom line, boosts the stock price, which pleases the major shareholders.
What else?
There's also concern about competition and prices.
How does that work?
Think about it. If BlackRock owns a big chunk of Nike and a big chunk of Adidas,
Competing companies.
right, does BlackRock really want them to engage in a brutal price war that hurts both companies' profits? Or are they maybe happier if both maintain healthy profit margins?
Because BlackRock profits either way.
Exactly. They're a major owner in both. So this universal ownership might subtly dampen competitive intensity across industries. Less incentive to slash prices to gain market share if your biggest owners own your rivals too.
It's like what did the source call it? A neo-monopoly?
Kind of.
Yeah.
You don't need formal mergers. The ownership structure itself might reduce competition, leading to potentially higher prices for you and me.
Okay, so that's influence through ownership and voting, but that's not the whole picture, is it?
Not at all. BlackRock also wields influence through, let's say, less formal channels. They have a lot of friends in high places. They engage constantly with companies they invest in. One study found they had over 1,500 private meetings or calls with portfolio companies in just 1 year.
So talking behind closed doors rather than just voting.
That seems to be their preferred method. They apparently believe quiet diplomacy is more effective than public confrontation, like voting against management. They might give management a year to shape up before voting no.
And then there's the government connection,
Right.
the revolving door.
Oh, yeah. It's well documented. People move constantly between BlackRock and senior roles in government. The U.S. Treasury, the Federal Reserve.
Central banks overseas, too.
Absolutely. And international bodies like the IMF, the World Economic Forum.
How many people are we talking about?
One count found at least 84 former government officials, regulators, and central bankers hired by BlackRock since 2004.
84. Wow. And Larry Fink himself, he's on the WEF board, right? Wasn't he even tipped for Treasury Secretary once?
He was, yeah. Didn't happen, but he was definitely in the running. It shows the level of connection.
And these connections were useful during, say, the 2008 crisis.
Very much so. BlackRock got contracts from the government and the Fed to help manage some of the toxic assets from failing institutions like Bear Stearns and AIG. Some sources called it a pretty sweet deal.
And after the crisis, they set up this body, the FSOC, to watch big financial firms, right? To prevent another meltdown.
Yes, the Financial Stability Oversight Council. And initially, they looked at firms like BlackRock and thought, maybe these guys are systemically important, meaning their failure could wreck the whole system. They considered designating them for stricter oversight, like banks.
But that didn't happen.
Nope. BlackRock lobbied hard against it. They even ran ad campaigns in D.C. metro stations targeted at policymakers.
Seriously. Ads in the subway.
Apparently so. And while they were successful, they avoided that stricter regulation.
How? What was the loophole?
It comes back partly to that passive label again. There seems to be this ability for them to effectively self-certify their passivity, arguing they don't exert control like a bank does, which helps them sidestep some of the toughest rules.
So they get to basically say, trust us, we're passive, and avoid the guardrails when trillions are involved.
It highlights the complexities and maybe some gaps in financial regulation.
Okay, this is already pretty tangled. But there's another layer of interconnectedness, right, within the asset managers themselves.
Oh, this is where it gets really circular. Get ready for this.
Who are the biggest shareholders in BlackRock?
Don't tell me.
Vanguard and State Street.
No way. The other big two?
Yep. And who are among the biggest shareholders in Vanguard?
Let me guess.
BlackRock.
BlackRock and State Street. And in State Street, BlackRock and Vanguard.
So, they all own big chunks of each other.
It's this loop. Asset managers are the shareholders of asset managers.
My head hurts.
And it extends beyond just them. This web connects to private equity firms, big insurance companies. It's like the financial sector increasingly owns itself.
So let's try to sum this up. BlackRock manages trillions, mostly our money via pensions and stuff. They make billions from fees. They own shares in almost everything.
Universal ownership.
Right, which gives them voting power, often making them the biggest voice, even if they vote with management. They have deep ties to government.
The revolving door.
And they own each other. It's a lot.
Yeah. The picture painted by the sources, is one where they profit from almost every part of the economy, wielding just enough influence, often behind the scenes, to keep that profit flowing, funded by things like teachers' retirement money.
And they do it by using the rules, the loopholes, exchanging money for access and power.
It's crucial to be precise. They don't own everything outright, but they own shares in almost everything, giving them this outsized influence. And the argument is this contributes to a system where, as one source puts it, their pie gets bigger and ours gets smaller.
The ultimate endgame of the investor management alliance, that sounds dramatic.
It does frame it starkly.
Is anything being done? Are there any checks on this?
Well, there are some moves. The Consumer Financial Protection Bureau, the FDIC, they're looking at whether large asset managers that own big stakes in banks should face tougher rules, similar to the rules banks face.
That seems logical if you own a big chunk of a bank.
But predictably, BlackRock and the industry are lobbying against those potential regulations. They argue it's unnecessary.
Of course. So resistance to change.
Significant resistance, you'd imagine.
Okay, so wrapping this up. The takeaway isn't really that BlackRock is some evil entity that created this whole system single-handedly.
No, it's more that they are perhaps the ultimate navigators and beneficiaries of the current system, a system some call a shareholder oligarchy.
Where the incentives for those with the most power, the biggest shareholders, align with making things, as that source bluntly put it, worse and more expensive and not work for us.
It's a provocative conclusion, suggesting the system itself needs reevaluation. The underlying sentiment is that maybe we need a system where the people actually generating the wealth have more say in how it's used and distributed.
Wow. Okay. That was definitely a deep dive. A lot to process about BlackRock and how our financial world is wired.
It really makes you think about those connections, doesn't it? How this structure might affect everything from the price of groceries to your wages, even your retirement fund.
Absolutely. It's everywhere, even when it feels invisible. So maybe a final thought to leave everyone with.
Go for it.
Given this incredibly complex, interconnected, and concentrated system we've just explored, what kind of fundamental changes would actually be needed to make it feel more equitable, more representative? How do we get to a place where the benefits are shared more broadly and the power isn't quite so concentrated at the top?
That's the multi-trillion-dollar question, isn't it? Definitely something worth digging into more, thinking about those power dynamics and what a different structure could look like.